us now is Michael Hewson. He's a market analyst at CMC Markets, and still in studio is Peter Major, Cadiz Corporate Solutions. Michael, thank you very much for your time. Obviously, the story of the hour, of the week, of the month is the US dollar. We have seen that 140.30 level on euro dollar, and at the moment, ahead of the FOMC minutes set to be published in the US, giving some indication of what happened in that September FOMC meeting, we are seeing some strength, relative strength, let's call it that, returning to the dollar. Just your thoughts in terms of where we're headed. Is this just a temporary reprieve on the greenback? Well, that's a very good question. I mean, when you consider where the dollar was over a month ago, it's come a very long way in a short space of time. And I think as we get nearer to the FOMC, I think there's going to be a lot of market speculation as to what sort of measures the Fed will take. Now, I think last week there was speculation that the market had factored in around $1 trillion worth of stimulus. Well, I can't imagine that the Fed will look to that sort of figure at its November meeting. What they may start to do is sort of drip feed stimulus into the system over the coming months. Now, if that's the case, that could result in a dollar rally, and we're certainly seeing some evidence of waning momentum or downward momentum on the dollar, and I think the last thing the Fed wants is to have a run on the dollar. So what we could have here is a slight dollar rally after the losses that we've seen over the last month or so.
Mike, can you give me a range? What's your gut tell you the dollar-euro range for the next 12 months? What do you think it's going to be in?
The next 12 months? I will be very, very surprised if it goes much above 141, 142. So I'd certainly be looking around 142, 122.
Yeah.
Recently I spoke to Simon Smollett from Credit Agricole in London, saying technically he's very cautious on the dollar at the moment because it looks as though we could go all the way to 152 on euro dollar. Is that far too bearish in your book?
I think that's very bearish, and I think the European Central Bank might have concerns about that because of the effect that it would have on the peripheral countries who are battling massive budget deficits, massive debt overhangs and fiscal austerity. The last thing they want at the moment is a higher euro. I mean, it's really going to make their lives a lot more difficult, and certainly the comments out of the European Central Bank recently, Benny Smaghi and Junckers as well, indicate that the European Central Bank are not comfortable with the euro above 140, and I certainly think we could see further easing from the European Central Bank in Q1 of next year.
Mike, one other question. Nobody feels sorry for the poor Japanese. They've probably had the world's strongest currency out of 200 countries. Can it get stronger than 82, 83? Do they have a chance of weakening their currency?
Well, if you line up the Federal Reserve against the Bank of Japan, the Federal Reserve are going to win every time. I mean, how much lower can rates go in Japan? They can't go any lower. They can't really go much lower in the US. So at the moment, it's a bit of a race to the bottom. And I think with respect to the Japanese yen, the all-time lows at 79.70 are certainly within reach. Whether we see them in the next couple of weeks is another matter, because I certainly think that the Bank of Japan might look to intervene again.
But is that intervention really going to make any difference? It didn't make any difference in the first round of intervention in terms of the Bank of Japan trying to stem the strength that we're seeing in the yen.
No, I don't think it will make any difference in the short term, and certainly not in the long term. But what I think the Ministry of Finance wants to avoid is a disorderly advance in the yen. And at the end of the day, you can't buck the market, so they'll have to just make do with whatever the market throws at them. But I certainly think we're due a dollar rebound, and after the November meeting, I certainly think that the focus will shift away from what the Fed are doing and more onto Europe and maybe the sterling, and it will be less about the yen.
So if you think Japan really can't do anything about their currency, what's that say about South Africa? Certainly we can't have any more effect on our currency than the Japanese.
No, you can't. I mean, at the moment, the rand has strengthened quite a lot against the dollar. It's broken that 5-year uptrend from 2005. I think if the rand can get back above 695, there is a trend line from the August highs at 743, 744. If it can break above there, we could certainly get a small correction back to around the 710 level. But still, obviously, the upward trend in the rand will still remain intact, certainly with respect to that.
What if we can't get above 695? What if we go all the way and close convincingly below 682? Doesn't that open up 650, perhaps even 6?
On a technical level, absolutely, it does, most definitely. In the short term, I really can't see that happening at the moment. You know, with respect to the US dollar, I mean, and the Japanese, and maybe even sterling currencies are on a race to the bottom, and you've got the same problems in some respects as countries like Brazil have. You've got too much hot money flowing into your currency and no effective way of stopping it apart from maybe implementing exchange controls, you know, and no one really wants that.
Michael, with all the headlines around currency wars globally at this stage, do you have clients phoning you up on a day-to-day basis saying, what are the implications of global currency wars?
It's certainly a factor. I think the threat of currency wars is slightly overstated at the moment, because I think if we were to go down that route, it certainly benefits nobody. So I would think that good sense will prevail with respect to the G20 and the IMF. There was no criticism from the IMF with respect to the Japanese intervention. So I think certain measures, I think a certain responsibility also lies with the Fed here, because, you know, at the end of the day, if they continue to devalue their currency by sort of stealth, if you like, then I think it's going to create a lot of tensions, notwithstanding with China and Japan, who own loads and loads of US treasuries. And I think they might have something to say about that if the Fed still continue to devalue the dollar.
Michael, it's been a pleasure talking to you this afternoon. Thank you very much for your time. Michael Hewson is from CMC Market. Peter, coming back to our market discussion, and we were saying that you are starting to take some profits at 29,775, particularly in the financial and industrial space. Yeah, both of those sectors have run hard.
Yeah, I thought that industrial looked the easiest. It's run the hardest. It's punched through all-time highs, I think 6-7 months ago. I think it's 10% above where it was 2 years ago when our market took a hit. And it's on the back of the strong currency.
Do you buy, well, you obviously don't buy the argument that foreigners deem us to be one of the more inexpensive emerging markets. Hence, if you look at us compared to Brazil, to China, we do offer value, particularly in the retail space. And that's why the retailers continue to shoot the lights out, despite gentlemen like yourself saying, listen, there's no way that you can justify valuations on these stocks.
Man, these retail stocks, I don't understand. I see the trade flows. I think it's up to 90 billion coming into the country. And I've seen figures that say 80 billion is going into our bonds and money market. So that tells me they're not coming here because our market's cheap. They're coming here because they're getting a good yield on an appreciating currency. You know, if only 10 out of 90 billion is going into our equity market, it won't take much for that to turn around.